Have you heard the tale of compound interest? You were told that if you save 3 kopecks a day, in 40 years, you will become a millionaire. Mathematically, this is true. But there are nuances in life that sellers of successful success are silent about. Investing is not magic. This is a rigid, cynical mechanism for the redistribution of resources, and it starts working for you only if 5 iron conditions are met. If you do not have at least one of them, any attempt to make money work will end with the loss of a deposit, a nervous breakdown, and hatred of capitalism. Today we will not draw castles in the air. We will build a bunker. I will analyze 5 fundamental levels, without which entry to the exchange is strictly prohibited. We'll talk about why trying to get rich quick is guaranteed to make you poorer. How your own brain will sabotage you at the most crucial moment. And most importantly, I will give you a clear instruction on what exactly should be at your heart before you decide to buy your first asset. Watch until the end, because the 5th point is the very reason why even Nobel laureates lose their fortune. Let's start with a base that 90% of newcomers ignore because of greed. The first condition is the complete cleansing of toxic debts. Sounds trite? Maybe. But let's look at the numbers, because the numbers don't lie. Imagine the situation. You have a credit card with a grace period that is about to end, or a consumer loan for a new phone at 25% per annum. And at the same time, you have a free $10,000. Emotions are screaming, buy Bitcoin, buy shares, if they grow by 100%. But logic whispers something else. The average historical return of the stock market, if we take a wide stock index, is corrected around 15-20% per annum in the national currency over a long distance. That's if you're lucky. And now look at the rate on your consumer loan. 20, 30, and taking into account insurance and hidden fees, the whole 40%. Investing with such debts is like trying to get water in a bucket that has no bottom. We're trying to earn 15% by giving the bank 30% guaranteed. This is mathematical suicide. This is negative selection. Of course, we need a nuance here. I'm not talking about a mortgage with a rate of 5 or 6%, if someone has any. Cheap money that is lower than inflation cannot be extinguished ahead of schedule. This is financial leverage. But when it comes to consumer loans, car loans, or credit card debt, it's financial oncology. I almost fell into this trap myself in 2015. It seemed to me that I would be able to outplay the bank by borrowing money and investing it in a growing dollar. Do you know how it ended? It swung in the wrong direction for only a week. The nerves gave up, I recorded a loss, and the bank had to pay interest for another year. Therefore, right now, pause the video for just a second. Open your bank's app, go to the loans section, and look at the percentage of the total cost of the loan. This figure is higher than 15, forget about the exchange. Your best investment today is early repayment of this debt. By repaying the loan at 30% per annum, you essentially earned this 30%, guaranteed, risk-free. No hedge fund in the world will give you such a guarantee. First, gold the holes in the ship, and only then put the sails. The second mandatory element is the airbag. No, this is not the money that you set aside for a vacation or for a new iPhone. This is your Freedom Foundation. Why is this critical for the investor? Imagine that you bought great assets, stocks of reliable companies, but the market, is cyclical. Tomorrow there is a crisis, a pandemic, a geopolitical conflict, whatever. Your portfolio is blushing and sagging by 40%. Normal. It's part of the game. Smart investor at this moment sits flat or buys more. But if you do not have an airbag, and it is at this moment that you are fired from your job, the car breaks down, or, God forbid, you need money for treatment, you fall into a trap. Life forces you to sell assets, and you sell them at the very bottom, fixing a huge loss, just to buy food or fix the car. The market smells fear. Market is merciless to those who do not have a margin of safety. I saw it with my own eyes in March 2020. The people who invested in the latter were panicking and selling everything when the markets crashed. They lost half of their savings. Those who had an inviolable amount for deposits equal to expenses for 6 months calmly drank tea and watched the schedules. They knew they had a lot to live on. The poor invest to survive. Rich invest because they have surpluses. Remember this phrase: be the one with the surplus first. An airbag is your armor that protects you from stupid emotional decisions. The third filter is knowledge, or, as I like to say, competence. Warren Buffett once said a brilliant thing: never invest in a business you don't understand. Sounds simple, right? But what do newcomers do? Open Telegram channels with names like Signals from God or Crypto Millionaire and blindly repeat transactions by anonymous authors. They buy shares in biopharmaceutical companies without understanding at what stage of testing their medicine is. They buy cryptocurrency without knowing how the blockchain differs from the database. This is not an investment. This is a casino. And in this casino, you are a chip played by others. If you can't explain to a 6-year-old why you bought this asset and how it should grow, don't buy it. Market punishes ignorance with the dollars. I remember the story of one popular Russian company whose shares were dispersed in all social networks. People scored millions of securities without even looking at the financial reports. And in the report, it was written in black and white: losses are growing, debts exceed assets. A month later, the bubble burst, and the stock plunged 80%. People wrote petitions, complained to the central bank, but the money had already gone to those who could read reports. You do not need to be a professional analyst, but you must understand the basic principles: what a stock is, what a bond is, how inflation works, and the key rate. If you are too lazy to understand, this is normal. Then your choice is broad index funds. It's boring but reliable. But do not go into the choice of individual shares if you are not ready to spend hours studying the business. Spend your first $10,000 not on buying shares, but on buying good books on financial literacy. Knowledge is the only asset that cannot be taken away, devalued, or blocked. Since we are talking about knowledge and understanding of processes, I often see people drowning in a sea of information noise. The news contradicts each other. The experts change their shoes in the air. The fourth condition is regular cash flow. Let's shatter another myth. Myth that you can get rich by investing pennies. Yes, the compound interest works, but with small amounts it works very slowly. If you invest 1,000 rubles a month at 15% per annum, in 10 years you will have an amount that is barely enough for a used foreign car. It's not wealth. Investment is an accelerator, not an engine. The engine is your active income. Many newcomers make a fatal mistake. They spend hours analyzing charts, trying to gain an extra percentage of profitability on their capital of $10,000. This is an irrational use of time. If you have a small capital, your main task is not to invest, but to earn. The best investment at the beginning of the journey is an investment in yourself, in your professional skills. Take courses, improve your skills, learn the language, learn how to sell. Doubling your active income will give you much more money in the long run than the most successful deal on the exchange for $5,000. Investments start to work for real when you can set aside and invest substantial amounts regularly. Discipline hits the classroom, but to have discipline, you need a resource. Do not try to squeeze the juice from a dry lemon. First, find a source of water. First career or business, then sex from money management. And so we got to the fifth point, the most difficult one, the one where even smart people with money break down. This is psychological stability and the planning horizon. In psychology, there is the term loss aversion. We experience the pain of losing 1,000 rubles, twice as much as the joy of finding the same 1,000. Evolution has taught us to fear risks in order to survive on the savannah. But in the stock market, that instinct works against us. When the markets are growing and everything is green, we are driven by greed. We buy on highs because we are afraid of losing profits. When the markets fall, we are driven by animal fear. It physically hurts us to see the red numbers in the app. And we sell for days to stop this pain. We do exactly what we can't do. We buy expensive, we sell cheap. I know people who panicked into cash in the spring of 2022. They recorded losses of 40–50% because they were sure that this was the end. The world is collapsing. And those who had a plan and nerves of steel simply continued to buy cheaper assets. After a year and a half, their portfolios not only recovered, but grew significantly. Psychology is more important than analytics. To be an investor, you need to be a bit of a robot. You must agree with yourself on the shore in advance what I will do if my portfolio falls by 30%. If your answer is, I will panic and sell, you cannot go to the exchange. Your tool is a bank deposit. If your answer is, I will buy more because this is a sale, welcome to the club. In addition, the horizon is important. Stocks are a tool for the patient. If you need money in a year, for a wedding, for repairs, for a car, do not dare carry them to the stock market. A short distance, the market is chaos. It can fall at any time. But at a distance of 5, 10, 15 years, the market historically always grows, overtaking inflation. Investing is a marathon, not a sprint. If you are not ready to freeze capital for at least 3 years, it is better not to even start. And remove, for God's sake, the broker's app from the first screen of your phone. The less often you go there, the more your nerves and your capital. Let's sum it up. Investing is great. This is really the only way to true financial freedom. When you don't work for money, but money works for you. But it's an adult tool. Not according to the passport, but according to the level of responsibility. Giving a first grader a chainsaw is a bad idea. A person without a financial foundation access to margin trading is an even worse idea. Your path should look like this and nothing else. 1. You pay off all the bad debts. Step 2. You form an airbag for 6 months of life. Step 3. You upgrade your skills and increase your active income. Step 4. You learn the basics. so you don't have to be a blind kitten. Only then, step 5, you begin to invest free money for a long time with a cold mind. Look at your life right now, honestly. No illusions. Do you have any debts? Is there a stash for a rainy day? If the answers don't please you, don't be discouraged. That's great news, because now you know the truth. You are at the starting point. Awareness of the problem is already half of the solution. Take one small action today. Do not immediately run to extinguish the mortgage. Just write down all your debts on a piece of paper. Sort them by interest rate, from the highest to the lowest. And make a plan for how you will kill the most expensive enemy. This will give you such a charge of dopamine that no purchase of shares will give. If this video has become a cold shower for you and may have saved you from a fatal mistake, like it. This will help the algorithms show the video to other newcomers so that they don't break the firewood. Be sure to subscribe to the channel. Here we instill common sense and treat financial illusions. Your money, friends. See you in the next video.